All right. Today is Thursday, June 15th. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. Let's begin with this. The viewer says, great video as always. I learn a lot just by listening to you explain how you do things. Love all the options and the other types of lessons like what's important to look for on a balance sheet. Always taking notes. You're the only financial YouTuber I never miss. Thank you so much. Appreciate it, really. Also reading what type of markets we're in or heading towards, when to look for rotation, and where to expect money to go, what types of indicators to look for. All very helpful if I would only act on the information in a timely manner and with some fortitude. It takes time. Sometimes it takes time. In a market like this, things move really fast. And sometimes that can be intimidating. The good news is the market always offers opportunities. On the upside, on the downside. There is always a trade to make. For example, a lot of people made money chasing the Qs this year, the AI hype. Others made money chasing the weight loss mania in Eli Lilly and NVO, for example. And then you have some bears who made a lot of money this year, shorting banks and regionals and all of that, KRE. So there was always an opportunity, and the problem is, in the environment we're in right now, we only look at it from one perspective alone. Look at what the big caps are doing, look at what the indices are doing. But there are always opportunities underneath, besides what your eyes sees immediately. And of course, there will be a lot of opportunities when things go the other way. And an important key for discipline is you don't want to go heavy in your bets or trades until certain indicators start to line up for you. It doesn't matter what your bet is. Going long, going short, trading this, trading that, doesn't matter. But you need to see some things to say, okay, I'm ready to go. And this is what we try to cover in this program. But then, of course, the most important question is, not sure how I could suggest any improvements. Well, I just told you how. You got to start to see more things aligning with what you want to do. The key is which ones you have to look for. So the viewer says it would be nice if you just told us what to buy, but I pretty much understand why you can't do that. Anyways, thanks. Now, you make an important point. Because a lot of you're not the only one talking about a rotation. A lot of people talking about it and saying, hey, Maverick, what do we look for to confirm a rotation? And where will the rotation be? Is it going to even happen after all? Because what if it doesn't? I mean, you look at certain charts, if you look at metals, if you say, hey, we should rotate to the cyclical side of the economy, the expansionist side, and you look at a chart like FCX, Freeport-McMoran, this is pretty much a copper chart. You look at this and you can make a case that this should be the next stock to buy. This is where the rotation should be. And of course, there are a lot of indicators and fundamental reasons why not to do it, why this should go down, not up. Most importantly, China, the upcoming recession. And then we go back and forth. Okay, but we have a stimulus coming in China. Maybe that's going to solve the problem. The Fed is easing, so maybe recession is not going to happen as fast or as deep as we thought before. We can debate these things from a fundamental perspective, from a technical perspective, from a rotation perspective, why this sector makes sense more than the other. You look, for example, at the IJR, which is pretty much the IWM small caps. You can argue that this is a reverse head and shoulder formation. This is where the rotation should be. This is where the rotation should be played. Then you look at the weekly chart for JETS. This is the airlines ETF, up about 20.5% recently from the consolidation in May. Maybe this where the rotation should happen. You look at, for example, the KRE regional banks. Maybe this is where the rotation should be played. It's up about 30% since the recent rotation, or at least some short covering and rebound. You look at the Dylan Mulvaney ETF, for example, who was pretty much on fire today. Whether we're talking about Bud Light or Target, look at Target, up about 9.5% from the lows to the highs. Maybe this is where the opportunity is. You look at the XLI Industrials weekly chart, bull flag, playing out. Never really was a bad chart, even in 22, because a lot of these names are inflationary. Maybe this is where the real opportunity is. Then you look at XLP Staples, which I'm liking more and more right now. Since we talked about it, up about 3.5%, maybe this where we should rotate, and you can make a fundamental case that, hey, look, inflation is going down, but a lot of these companies in the consumer staples and food, they retain the pricing power, but their input cost goes down. So their margins are going to improve dramatically. You look at the XLV healthcare, again in consolidation, and it never was a bear chart at all, even in 22. It only consolidated, and it is a defensive sector. If you're betting on a recession or a slowdown, this sector happens to have some of the best balance sheets ever. Lots of cash flow, reliable income, reliable cash, lots of dividends. Maybe this is where the opportunity is. And you can make a fundamental case. You can say, hey, look, the Fed is pausing. They say they're going to raise, but maybe they're not. And this means that yields will go down. And if they go down, all of these dividend stocks become really attractive again. And you can make a fundamental case for the healthcare sector. But like we said, we shouldn't just be sucked in, because you can make cases right now all you want. But at the end of the day, you got to have a list of indicators and things you have to follow to confirm where the rotation is, and most importantly, whether it's happening to begin with in a sustainable way. Some of these indicators come from the dollar and yields. For example, you can make the case that the rotation should be in commodities right now, and that would be the subject of tomorrow's video. Because Jay Powell is backing off, he admits that inflation will go higher next year, and the Fed will keep rates low. They're going to cut rates next year, so maybe they're going to surrender to inflation, and the real trade and the opportunity should be in commodities. Today we got the ECB raising rates, we got the Fed pausing rates. The end effect of that is the dollar goes down, which will reinflate commodities. So you can make that case, and you can track these things to validate your case. And if you see more and more and more, then you should follow. That's how you get the fortitude, is when you have so many indicators that you put for yourself. Not too many though. They're all confirming. You're not going to feel stupid, because if you make a decision, you end up being wrong. You're not going to feel stupid because you made a case, you studied a case, you looked for indicators. You've been validated. And 9 times out of 10, this works. This is the right approach. Then you have the 1 out of 10 cases, like we have right now in the market, where you look at all the indicators and nothing makes sense. Yet the market, the technology, the big cap companies, the AI mania keep going. And actually the indicators go contrary to the move. So for me, I look at that and say, okay, I don't need to chase that at all, because it looks as a bubble. Bubbles go contrary to indicators and contrary to logic. But the beauty of bubbles is they go higher, out of whack, out of control, and then they come down crashing. And there's an opportunity in making money in that leg of the move. But unfortunately, we as retail traders and investors have been wired to chase. Because when we represent the opportunities in the stock market, we say, oh, look at this stock, it was trading at whatever price, now it's trading way higher. If you bought here, you made this right now. But seldom when they present the case of, oh, if you bought here, now you're down to this, because this stock did not recover for 20 years. And if you shorted here, you made this much here because this stock crashed. You can look at not so impressive chart, for example, not moving 30% year to date, maybe moved 5%, but somebody made 300% buying calls on that move. On a 5% move. The opportunities are all over the place. They're not singular to chasing what's working right now. And in determining the rotation, the validity, number 1, and where, number 2, we have to understand all of these concepts. But you have to wait for important events to pass first. And this week is pivotal because it has a lot of macro, a lot of Fed, and most importantly, quad witching, and a record number of call options. So we have to wait for the resolution tomorrow, the finale. And then let's see what happens next week. How all of these charts that I just showed you are moving. We look at different indicators for each sector. We make the case for each sector. Why the rotation is valid here, why it's not valid here. And we use these indicators to track each sector. And the more a certain sector is validated, the more attractive it becomes to us to rotate to. Or for those of us who did not really participate a lot in the stock market, aka missed out, you can chase this opportunity. If it is indeed a bull market, and if it is indeed a valid rotation, that part has not been yet validated that this is a sustainable rotation or even real. A great test for any rotation, for example, is the sector that is really overbought right now, that we expect money to rotate from to these new areas in the stock market. In this case, in our case, the Qs, the Nasdaq, the AI mania. Usually we see a big flush down as we reach climax. The ending is usually marked by a big flush down. How will all of these sectors and stocks that I showed you right now hold as money comes out of that big, really important sector? Because if the Qs and the AI mania go down big, we see stocks down 8, 9, 10% in a single day. But then the IWM is down, commodities are down, healthcare is down, staples are down, industrials are down too. Then we don't have a rotation. And we haven't tested that yet to validate the rotation to begin with. So again, stay tuned in this channel. We have an important video coming out tomorrow for commodities, what the ECB did versus the Fed, the case for commodities, the bullish case for commodities, and reinflation. And then, of course, depending on how we close tomorrow, we'll see what the topic is going to be for Sunday's video. Most likely, it's going to be looking at these rotations, what indicators we have to look for, which sectors are more attractive than others as candidates for a rotation. Anyhow, we have an important day coming out tomorrow. And the reason is we have quad witching. And again, for the newbies to the stock market, recently quad witching is more hype than reality. Meaning they say, oh, watch out, we have whatever trillions of dollars worth of options about to expire today or by the end of the week, and a lot of volatility might happen. And it never does. But in the past, it happened a million times. We have seen epic moves in quad witching. We could see one tomorrow for all we know, because the setup right now is really attractive for an epic quad witching move, a max pain move, and I explained why. The combination of a really low and shorted VIX, heavily shorted I must add, and zero date till expiration phenomenon, which we see insane numbers of, and I'll show you that in a minute. The combination of both with a market that is just continues to go higher and defy any technical limitations. It becomes really, really overbought in the RSI. The combination of these factors could lead to Volmageddon, could lead to a phenomenon like the flash crash or 1987. All of these events are unexplained, but they happen due to a mechanical move. Am I saying it's going to happen? I'm not saying that, but the conditions are here for it to happen. So let's talk about it. You know, today I made a midday report, which will probably serve as tomorrow's morning brief, because nothing changed in the numbers at all that I shared with you. But at the time of the note, when I was writing the note, the highest volume for the Qs when it comes to zero DTEs were actually for puts. It was the 365 and the 360 puts. But as I wrote in the note, I was looking at the Bloomberg terminal. I mean, this is bar chart. The data is kind of delayed 10 to 20 minutes. But if you have Bloomberg, you can look at the flow in real time almost. And I'm seeing a lot of the 370 calls coming in. Lots of them. Zero DTEs. And then look at this. By the end of the day, almost 100,000 calls. We're talking about contracts here. For the 369, over 80,000 contracts. For the 370, almost 70,000 contracts for the 371, and a combined 120,000, a little over that, between the 367, 368 calls. So these are block trades that are coming at around 10, 10:30, 11 by the end of the day, and they just pour in, and they create a lot of volatility by the close. We see sharp upward moves and then the dumping because they're cashing in on these zero DTEs. So this kind of distortion in the market will have to be fixed at some point, and therefore we say there is a massive correction coming. We don't know when. And the fear, of course, or maybe the delight for some of you, will be if it comes in a 1987 Volmageddon style. 87 doesn't happen anymore because the SEC made regulations to prevent that. We could see a flash crash. We could see Volmageddon. At some point, this will lead to a massive accident, folks. And here's the thing. A lot of you use these services online. Where is Max Pain? And most of them will say, hey, Max Pain for the SPY tomorrow is going to be 415. I've seen 410. I've seen 420. I've seen 400. But the bottom line is the maximum pain is way below where the stock is trading right now. So what does that mean? Are we going to see a crash tomorrow? The answer is, I don't know. But what I know is the market maker is pragmatic. They've been hedging as this move goes on. Who do you think been buying the SPY and the Qs? It's not real folks. It's the algorithms buying on behalf of the market maker because they're selling a lot of calls. And if it is true that max pain is 415, then the SPY should go down by 6% plus in tomorrow's session. Again, have we seen it before? The answer is yes. Have we seen it recently? The answer is no. What are the odds on it happening? Above 50%? The answer is no. But is it above the threshold for comfort? Let's say comfort is 10% and the probability of this is happening is 18%. That's a little too high, don't you think? But we have to look at the SPY, calls, expiration date tomorrow. If you happen to be the market maker, forget about 415 right now. You've been buying a ton of SPY shares because they've been buying a ton of calls, a historic amount of calls, all-time highs. But you look at the most immediate ones. You got the 440 with about 70,000 contracts open right now. As the market maker, wouldn't you like to deliver a bag to these folks? So if you go and you close the SPY at 440 or a little below 440, wouldn't that be a satisfactory outcome for you as a market maker? The answer is absolutely. So that could be the move. They just close it below 440. Now, is there a possibility that the market maker will get squeezed to the upside even more? The answer is yes. Look at the open interest at the 344, 345. It could happen, but the market maker will give it a shot, and they have a lot of power. They're going to give it a shot to close below 440. Any consequences for the market maker to close below 440 if we look at the puts? The answer is not really. The number of contracts of puts is really anemic. Nobody's buying puts anymore. If you listen to the perma monkeys, for example, online, they would say, oh, this rally is happening because the shorts are capitulating. The bears are buying. The answer is there are no bears. There are no shorts. This is a stampede. This is a stampede in buying shares and calls. So So the market maker has the room to go all the way down to 435 before they encounter some high open interest for puts. In other words, the odds for the SPY to go down below 440 all the way to 435 is highly likely. When we look at the Qs, for example, here are the calls with the expiration date of tomorrow. And we look at the highest open interest at 365. Again, if you look at the actual max pain for the Qs, it's way down. So unless the Qs crash by 10% tomorrow, we're not going to get to the max pain. What if it is satisfactory to the market maker to close below 365 and make those 25,000 open interest contracts eat a bag? That's a win for the market maker. Is there an outcome where the market maker gets squeezed to the upside? Yes. If we get to the 372, 375 territory, yes. But what is the punishment for the market maker if it pushes the Qs all the way down to 365 or even below? We look at the puts, you have about 11,000, 12,000 contracts on the puts for the 365. So I would say that is the sweet spot right there. Maybe close the Qs at 365, a little below. No harm done. Then we'll look at the IWM. Massive amount of open interest for the 185. Again, put yourself in the shoes of the market maker. Wouldn't you like to make these people lose money? The answer is absolutely yes. So they want to close the IWM below 185. Absent of massive inflows coming from a rotation, the market maker will give it a shot to close below 185. What is the consequence from a put perspective? The answer is there is some. You got about 90,000 contracts open for the 185, so we know that the sweet spot is in or around 85. 185, that is. Maybe they loop around, they push it down in the morning, then they pick it up again, and they shake off the calls and put options holders for the 185, and they achieve maximum pain, as satisfactory as maximum pain can be. The actual number for maximum pain is way below. It's in the 170s. Then we'll look at NVIDIA, some of the important names. Here are the calls for the expiration date of tomorrow. Again, if you put yourself in the shoes of the market maker, you would like to close NVIDIA at least below 400 and make a few folks eat a bag. Those who are holding call options right now. Any consequence if the market maker pushes NVIDIA below 400 or closer to 400? The answer is sure, a little bit. There are a few open interest contracts in the puts here, so we could see a mini reverse gamma squeeze if indeed NVIDIA starts to sell off tomorrow. And look at the increase, the change in open interest today. A lot of folks buying puts with the expiration date of tomorrow. A lot of folks, if we look at the calls, closing their winning contracts and calls. So the market maker is going to receive this kind of feedback and they're going to react accordingly. Of course, we get more feedback in the morning that we don't know yet. They will see it and they will react according to that. Now, look at Tesla. Let's look at the calls here. If you happen to be the market maker, look at this. You'd love to close below 250, right? Make about 25,000 contracts, expire worthless, or better yet, go all the way down to 240. But 250 is good enough. And you can see that the buyers today, they're buying way out of the money. And this is why this one is stalling right now. And it's probably going to go down if we look at the puts. We're seeing volume coming in the money, a little out of the money. And what are the consequences if the market maker pushes Tesla below 250? You got about 20,000 contracts open right there. You got to pay the put options holders. It's a zero-sum game. If you're going to make somebody lose, somebody else has to win. But notice today, if you look at the calls or the puts, both of them lost money in Tesla. Both of them. So all of this money, we're talking about billions of dollars. All of this money is being collected right now by the market maker. The house always wins. Thank you for playing. But what do you care about 250 or 240? What do I care, Maverick? The answer is if you see, for example, Tesla trading at 250, it breaks 250, then the likelihood is the market maker wants to push it all the way down to 240. So you have this guideline. Though if it trades below 250, maybe I'll short all the way down to 240. Or if you want to buy the dip, for example, you see Tesla below 250, then you have to look for 240 as an opportunity for a rebound play. This information is important, folks. You just got to know how to use it. And then, of course, the most important one of them all is the VIX, the expiration date of tomorrow. Enormous amount of open interest contracts for the 15 contract and above. If it happens, if the VIX goes all the way to 15, starts to hit 16-ish, we're going to see the VIX exploding higher. It could be fireworks tomorrow. And again, I don't care if you're a bull or a bear, just as a market observer, wouldn't you love to see this happening? If it hits, you combine this with the information that I told you about maximum pain and how way down it is for the SPY and the Qs. Can you at least see the possibility that the VIX could explode above 15 and the market maker has to rush and cover for all of these contracts, pushing the VIX all the way possibly to 25, if not even more? Maybe to 30. And then we see the SPY indeed moving down to 410, maximum pain, and the Qs moving down to whatever maximum pain it is. Can you see the possibility? The The answer is yes. Can you put the odds on this possibility happening? I don't know. I would say 10 to 20%. And the reason is a lot of things have to align at the same time. We should see exodus by money managers and the big caps. They cash in a big way. We need to see some fundamental spark, whatever piece of news, whatever piece of data we get from a macro perspective. And then we get a lot of buying of the VIX. The VIX hits 15, 16, and then we start to see the market flushing down. So things have to happen before this phenomenon takes place. But is it possible? The answer is absolutely yes. And perhaps we need it to happen. We need somewhat of a massive wake-up call that, hey, what's been going on in the market right now is absolutely divorced from reality. We need a smack in the face, a glass of water, say, hey, wake up. We have a lot of problems ahead. A lot of these companies' valuations will not be able to live to any of these factors coming up, and there will be a reckoning. So we better wake up now before we hit that reality. We need the wake-up call right now for the sentiment to cool off. We're talking about over 50% bullish now. These are historic highs. We're talking about a record number of call options being bought right now. We know who the victims are going to be. It's not going to be the institutionals and the big shots. It's going to be the retail mom and pops feeling FOMO. And reality has to protect those who are about to fall to this FOMO. Those who already fell, it is what it is. They're going to learn the hard way. But those waiting to fall into this FOMO, they need to get a validation ASAP that we need to take a breather here and think about all factors. That's all. Anyhow, moving on to the market analysis, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average up by 428.73 points, or a gain of 1.26%. The Dow is the leader today. Unbelievable. The Nasdaq up by 156.34 points, or a gain of 1.15%. The S&P also in the green by 53.25 points, or a gain of 1.22%. Look at the sectors all in all. Beautiful. All of them in the green. If you are a fan of a rotation, today they gave you the buffet. If you want to rotate to healthcare, you validated today. Energy, you got it. Industrials, you're good. Financials, okay. Although you're going to get killed later. Metals, okay. You want to chase the AI mania? Also okay. Technology up. Communication services up. So today, they gave you everything, which again, you could look at this as a validation for the rotation and say, okay, now I'm going all in healthcare. But this could be also a sign of a climax. So you gotta wait till quad witching is over. We look at the breadth all in all, much better. NYSE 78% advancing versus 20% declining. NASDAQ 61% advancing versus 35% declining. Commodities, look at this. This is where the bull market is. Forget about Nvidia. Jerome Powell made a major mistake. And now that the ECB is raising rates, and Madame Lagarde is about to be even more aggressive, we see Bank of Canada raising. The RBA is raising. We'll see what the BOJ does tomorrow. If they raise too, the dollar is going to get crushed big time. If it does, the commodities cohort will start surging significantly higher. I mean, look at this. Look what happened today. We talk about crude oil, WTI, Brent, gains of over 3% for the day apiece. WTI was up over 3.5%. Gasoline, up almost 4%. Heating oil, up over 5%. And the party boy, nat gas, up 9% in a single day. Show me those BOIL gains. You look at softs, coffee, OJ, cocoa, all moving higher. And by the way, sugar is at the highs right now. Lumber, been moving higher for days. Took a breather right now. Cotton down, sure, that's the exception. But the rule is we're seeing reinflation in commodities. Grab the chart of corn, soybean oil, oats, exploding higher. Live cattle, feeder cattle, all at the highs right now. And therefore, we picked an opportunity in wheat. Look at wheat, up 5% in a single day. Folks, we know, or I should say I know, I'm not going to lump you into it, but I know, and my conviction is stronger than ever before, that the end of the story will be the end of the cycle, the end of this QE mania that we started about a decade ago. And with that will come a recession and a severe market crash. But what's going to happen between now and then is the unknown. And unfortunately, whatever the Fed does will change the path. If they double down and raise rates to take inflation down, then we head to the end of the story faster. But if they relax prematurely and we see inflation making a comeback, then the ending is delayed. And what happened between now and then could be a reinflation in commodities, could be another IPO mania, could be the stock market making a new high, could be another bubble forming, could be a rotation, could be anything. And this is why we look at the action today and we say, okay, could be the start of a new massive rally in commodities, but we got to see more. Moving on to options, the big casino, what do we see here? Volume is actually picking up a little bit. Again, for calls, no difference here. And by the way, this consistent buying of calls is exactly why the Volmageddon phenomenon is more possible than ever before. Of course, the usual suspects are number 1, 2, and 3, Tesla, Apple, Nvidia, all with a lot of calls. Above 60% of the volume was for calls. And again, they're buying the shortest possible expirations this Friday, next Friday, max. Folks, when you say that this is a bull market rally, who's doing the buying? It's a very important question to ask. If it is the funds, if it is the mom and pops, if it is people buying shares organically, believing that this is indeed a bull market rally, then it is. But if the market maker and the shorts are doing the buying, then it's not a real market rally. It's not a real bull market rally, I should say. It's a mechanical rally. We're not saying all of it. The first part of it, all the way to the SVB collapse, was actually, believe it or not, organic buying, mom and pops, managers, quant funds, shorts, everybody buying. But this piece that we've seen out of the consolidation range of April, this little piece is not organic. This little piece, it's not really little, it's big if you think about it. It's excessive and dangerous. But this piece is done mechanically because we have a lot of stampede in buying call options. And that will be corrected. And correction of these kind of moves are usually over-exaggerated and they overshoot to the downside. Keep that in mind. We look at the unusual activities that took place in the options market today. We begin with the ticker PDD Pinduoduo. The Chinese names are catching a bit because of the stimulus news. Of course, PDD is no exception here, although I would actually take the other side of this trade, at least in the short run, and then maybe buy the dip later on. Because it is excessive right now. If you look at the charts of Alibaba, Pinduoduo, all of them shot up really higher in a short amount of time. But here we have somebody betting that perhaps we have a little more juice to squeeze here, and they bought the 87 calls for the expiration date, June 23rd. With expectations that the name will move higher and gain more than 7.5% by then. They paid about 85 cents a piece to enter this trade, all in all, spending about $2 million. And then we have the LQD. This is for the corporate bonds, corporate grade bonds, I should say. And it should move higher in validation of this rally. And so far this week, it is higher, but it is way lagging the Qs and the SPY, and it was part of the consensus by the bears of why this rally is fake. Well, it got improved recently, but here we have somebody betting against all of that, and they bought the 102 puts for the expiration date, August 18th, with expectations that the name will go down and lose more than 5.5% of its value by then. They paid about 30 cents a piece to enter this trade, all in all, spending about $600,000. Then here we see the mania in Nvidia, Microsoft, Tesla. If you want to chase one of the three, I'd go with Microsoft. I'll tell you why, because it is the cheapest. I mean, look at these premiums right here. The reason why Nvidia is stalling and Tesla is stalling because the options are absurdly expensive, and you're going to need more and more volume to sustain this gamma squeeze. Otherwise, it's going to go down. We look at the example of Nvidia. Somebody bought the 475 calls. That is about 11% or more from where the stock is trading right now. They bought these contracts for the expiration date of July 21st, about a month or so from now. Look at how much they paid for those. Over $10 a piece. That's $1,000 a piece. And in this trade, they spent about $500,000 on those. Who has this kind of money? The answer is institutionals. Don't be surprised that a lot of these moves are done by institutionals. The question is, they need the collaboration of the mom and pops to keep this going. And we know that these snakes are not really in the same team of the mom and pops. They're using the mom and pops to their advantage to push these things higher. Then they pull the rug. And right now they need a lot more than this. They need a huge volume to keep Nvidia going on. Then you look at Microsoft. It is trading less than $100 away from Nvidia. Somebody bought the 375 calls, expiration date August 18th. The expectations are for Microsoft to move higher by more than 8% by then. They paid about $6 a piece to enter this trade, not $10 as we see in Nvidia for a shorter expiration date and a bigger move. All in all, spending about $420,000 on the Microsoft trade. Again, it is excessive. And for all we know, Microsoft goes down. But if you happen to be in the FOMO crowd and say, Maverick, I'm putting a gun to your head right now. These three trades, Nvidia, Microsoft, Tesla, which one would you go with? The answer is, duh, of course Microsoft. It is the cheapest for the longest expiration date. The hell's wrong with you? Look at Tesla, TSLA, buying the 292.5 calls for the expiration date June 23rd, meaning next Friday, expecting a move of 14% or more by then. And for that, they paid about $1.20 a piece to enter this trade, all in all, spending about $750,000. All I got to say is good luck. The market maker is about to make a killing right now. They're about to collect all of this money, billions and billions of dollars. They're not going to let you win for too long, folks. Anyhow, moving on to the heat map analysis, what do we see here? Much better breadth. You see financials participating, healthcare, although AbbVie is kind of pissing me off. It has been the underperformer in healthcare for a long time now, but we see Amgen moving, we see J&J, Eli Lilly all moving higher. Even the healthcare names and pharmacy names that we talked about in yesterday's video, they did recover. Cigna, the only one I own, recovered all of the losses. And then you got CVS. We talked about that chart yesterday. It recovered some of the losses. And maybe it is a buy right now. Maybe it is too cheap. But again, wait till Friday is over. Industrials doing pretty good. Utilities, real estate kind of muted, but we see inflows to energy. We see metals being bought. We see defensives working out. We talked about PepsiCo in last night's video. We talked about Target. We talked about Bud Light in previous videos, aka the Dylan Mulvaney ETF. Doing pretty good today. We'll look at the cyclicals, whether we're talking about Chinese names, auto stores, apparel, although hotels and casinos were down. That's interesting. Then you look at communication services, all up for the most part. Even the high dividend paying names, Verizon, AT&T. We see a recovery in T-Mobile. The big caps kind of working today. Microsoft in the leadership along with Meta. The laggard is Tesla, but it has been the high flyer as of late. But we see outflows from chips coming out. So this is the only clear sector where we see actual outflows today. And the question becomes, what did they chase with this money? It couldn't be that they rotated to Microsoft. They must have bought healthcare, they must have bought oil, they must have bought Target, industrials, or maybe they're holding cash. And until we find out this kind of information, we cannot validate a rotation. If it happens in a sustainable way, I'll be the biggest cheerleader for the rotation. But right now, you have to be, or I should say instead, you have to have a healthy dose of skepticism. We look at the ETFs. No complaints here. We see XRT moving, retail, banks, energy, metals, small caps, big caps, natural gas, metals, internationals. Everything's moving higher. Even the VIX moved higher. If you have the UVXY, the VXX, which I'm holding throughout this period right now, the VIX did pretty good. And we talked about periods when the stock market outperforms along with the VIX. Usually precedes a change in rhythm. I know I've been saying this for a while now, but we're just waiting on when it's going to happen. We know we're really close. We're getting really, really close. We have all the indicators lining up. Could tomorrow be the day? This is what we have to see. And maybe the charts will give us some clues here. So let's do those. SPY 30 minutes chart. What do we see here? Met 443 as resistance, closed below that. Chart is really overbought. We're waiting for a pullback. We talked about 440 as the most immediate target. We talked about 438. And the most reasonable extreme scenario is 430. Of course, there is the most bearish scenario, which is actual max pain, all the way down to 410. We'll see what happens. But what we know is the risk is now shifting from the upside to the downside. It's just a matter of when, not if. We look at the daily chart for the E-mini futures. Again, I think we have to clean up all of that move. So we have to go down to the bull flag. We have to close that gap. And I think this is what the next flush down is all about. Getting us back all the way to reality. And then we have to rethink what is actually going on with the Fed. What's really going on with the fundamentals, with earnings. Are we in a hype with AI mania? Are we getting a little ahead of ourselves? This is what this upcoming flush down is all about. And then we'll see what the market decides after that, after cooling down. That yes, we have evidence to continue to go higher, or, oh my God, the evidence says that we've overdone it here and we need to go down further. You look at the RSI, again, it is due for a pullback, a big one. And we're looking at 43.84.5 as the most immediate support. If that fails, then we're going to go down to closing the gap and erasing all of this mania mechanical move. I mean, you see these huge buying bars. These are due to a mechanical reason. These are due to algos, and we have to clean them up. They will be cleaned up. 1,000,000%. The question again becomes when, at what point, from what point? And the answer to that could be as soon as tomorrow. And by the way, that would be a downward move of about 3.75%, which is not really that extreme. It happened before. Could happen in 1 day? Sure. Could happen in 2 days? Throughout a week? Sure. But we know it's happening. Then there is the most extreme scenario that we go down all the way to the consolidation range. Again, I've seen some prediction that's going to happen in 1 day and the day is tomorrow. I don't know about that, honestly. Could it happen? Yes. Is it the most likely scenario? Of course no. Can it happen in a matter of weeks? Absolutely. And I think we should go back to that range and revisit the conversation. When we look at the cash index weekly chart for the SPX, it is above the range of the channel, which means if it pulls back tomorrow, it could close back within the channel. Is there an upside target? If you look at the RSI, for example, it is exploding higher right now, but it is not really that overbought. It could get even more overbought. In the extreme upside scenario, can we see the SPX at 4,500? The answer is it is a possibility, but it is not a lasting possibility. We'll look at the Q's 30 minutes chart. What do we see here? Above 370, the number that we talked about today, but we have another number that we talked about, which is 365, and we have a support, a really reliable support at 364.11. That would be my target, and then if it goes a little more, we have 360.42. You can see the RSI is really overbought right now, so we're due for a pullback, but we need the actual pullback. Because you can see in the 14th, we got an overbought reading on the RSI, and we did pull back, but not meaningfully though. We pulled back to 360.42 and then we went back to the races. Because in the case of the mediocre / quad witching is a nothing burger scenario, we could see the Qs moving down all the way to 364.11. That would be a downside of about 1.66%. Or we could go down to 360.42. That would be a downside of 2.66, which is again, not a big deal. We've seen these kind of moves happen before. In the most extreme scenario, of course, we go down 7, 8, 9%. And for that, we look at the daily chart. Again, way overbought. You can see the bars in the volume. This is mechanical buying, gapping higher. And the resolution of that is a flush down always. You just haven't seen it yet. Keyword yet. And the question becomes, if it is indeed erasing this last mechanical move, then we have to go down, let's say, all the way back to the trend line or to 14,445. That would be a downside of about 6.5% to 7.5%. Which is, again, not a big deal. If it happens in one day, it is a big deal. But it happens throughout, let's say, 3 days or a week, it is really not that big of a deal. So we're going to find out that this last mechanical move, the gap higher, that's a trap. And it is intended for the retail mom and pops and the capitulating bears to slaughter them. And do they deserve the slaughter? The answer is, unfortunately, yes. You don't capitulate. Not right now. If it goes down, let's say to 13,000, we consolidate for a little bit. We see things improving. The check marks, remember? The list, the validation. If we start checking those, then we can say, okay, the case is different now. And we can buy these names and the Qs at a better valuation. At 13,000, not 15,000. FOMO is for the suckers. There is no need for you to be a monkey. You're gonna get your opportunity. On the downside and the upside too. Chasing is usually the wrong strategy. And by the way, let's expand the horizon a little bit in the conversation. And we use the NDX, the weekly chart. Look at this. It is reaching the highs from last year at about 15,265.42. Now the chart is severely overbought. This is a weekly chart, not a daily one. In the mild pullback scenario, which is let's erase the filth, the mechanical move. And again, we talked about the overshoot that usually happens. Then we should be going down about 9.5% to about 13,720.91. If you want to go too extreme, which again, I'm not going to go there right now, at least in the first leg of the pullback, we could be down 14.18%. Again, is it going to happen in one day? The answer is not likely. But could it be a beginning of a process? The answer is yes. We have the conditions for these kind of moves. Again, my ultimate target at the end of the day is, if we zoom out and we use a monthly chart for the NDX, is to go back to trend. We've diverged from trend for a long time, and we're due back for a visit. And if this is the top for this AI mania rally, and we go down to my target, depending on when we go down, it'd be a loss of about 37%. And again, we've seen these kind of corrections before. It's nothing out of the ordinary. It's not doom and gloom. And of course, folks are surprised by the rally we've seen year to date. But is it really out of the ordinary? The answer is it is extreme in the extreme cases, but this is what we typically see. You go back to the .com, initial crash, then we have the rebound, the B leg, and then we go down. Nothing goes down in a straight line. Look at the Qs once again. The crash of 08 goes down, the initial top, then the reaction, the reflex, and then we resume what we started. Is it really out of the ordinary to see this? We crashed in 22, got the reflex this year, and then we have to go down and finish what we began. You see, the beginning of a bull market is not this impulsive. The beginning of a bull market, you can look it up, it is gradual. These impulsive reactions are the results of bear markets, and most importantly in our case today, a bubble forming within a bear market, and hence the distortion. We look at the IWM 30 minutes chart. What do we see here? Support 186, and you can see a trend line. Resistance 188, and we know the max pain is 185. Looking good right now, but we have to see what the market maker is going to do. If they flush this down and close it below 185, you cannot believe in the rotation. If we see the Qs down, the SPY down, but the IWM rallying to 188 and beyond, then we do have a confirmation of a rotation. We look at the Dixie, the dollar index, 4 hours chart. Look at this, massive flush down, and therefore I've been saying Folks are saying, hey, Maverick, when bazooka? And I say, I gotta see the confirmation from the dollar and yields. Otherwise, I'm not gonna blow up $2 million for nothing. A serious trade to that extent requires, we go back to the conversation again, requires the validation, the checklist, the indicators, what to look for. The more check marks you get, the more conviction and fortitude you have to make the move. We look at gold. The Dixie's down. Decent day for gold. It was not really that decent, in the morning at least, but it went down in a retest to 1928. Thank you so much for the move today, because I was like, why don't I just get it all the way to 1930? Why did I pick 1928 exactly? Maybe the algos agree with me, but we see improvement. We see a retest and a rebound closing at the highs. RSI improving, MACD improving. We got some of the check marks ready. What is the validation? Get me above 2,000 again, and the dollar closing the week down. And I'm in. I got my list. I got my validation. Look at the SLV. Underperforming today, but above 21.57. And again, we need to have the confirmation. UK oil, decent rebound, but again, we need to have the confirmation. Get us above 77 by the end of the week. We're in. What about the daily chart for the 2-year yield? Again, get us the confirmation. Close above 4.5, 4.59, I should say, or close below. And then we're going to have better directions for next week. Simple as that. We look at the TLT, big pop today. The 10-year went down big. We're talking about yields now, and we have a re-inversion of the yield curve. Here we go again. Can you buy the TLT right now? The answer is not really. You haven't gotten your confirmation. VIX 4 hours chart. What do we see here? Look at this. Saucer bottoming, holding 13.87. Check mark, check mark. RSI improving, another check mark. MACD not diving down, another check mark. What are we waiting for? We're not really waiting. I'm already in, but I would double down if 15 is in. That would be the big check mark, and then higher we go. Apple, the big kahuna, hourly chart. What do we see here? It is in a zombie grind higher. It's like dead, no volume at all. Just being bought by automation. Somebody buys the ETF, somebody buys technology, they buy Apple by default. And zombie moves like this with low volume, followed by this, a flush down. And I still see 177. We have to retouch this number precisely and then see what happens. Tesla, the souffle, look at this, above 249.16. You're going to see a loss of this support. That would be a check mark, validation, confirmation. You got the RSI, way overbloated, the highest ever. It's another check mark. You know where the gap is. That's your check mark. What are you waiting for? You got to look at the options. You see the reversal, more volume coming out for puts, less volume coming out in calls. Better yet, outflows. Then you know that the momentum is changing. That's another check mark. And we see Tesla losing 249.16. That's the ultimate check mark. And there we go. We look at NVIDIA. What do we see here in the 30 minutes chart? We lost the trend line. We have 420 as support. 420 is important. We lose 420. Your boy is going to double down. And then we go down to 400. Better yet, we close the gap at 395.65. And that would make for an excellent trade. Can NVIDIA go higher? The answer is yes. But we are getting to the expiration date. The odds say more likely than not it goes down than up. Have we been defied in the odds so far? The answer is yes. But I got time, baby. Last but not least, what about Bitcoin? What do we see here in the daily chart? If the dollar continues to go down, then perhaps, possibility, not confirmation yet. We have a wedge. We break above the wedge all the way back to the consolidation zone. Are you becoming bullish, Tulip Maverick? The answer is, if it works, it works. I don't care what chart it is. Right now, it's looking good. Will it look good in tomorrow's session? That depends on the dollar. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have Governor Waller, another rat from the Fed, along with Richmond Fed President Barkin. What is he going to bark about now? And then we have from the beautiful town of Ann Arbor, the University of Michigan. We get consumer sentiment and inflation expectations. And this will be really important. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Buckle up.